Today, I'm going to be showing you the data that suggests the worst is yet to come. Most of the time, investors talk about whether we're in a bull market or a bear market. So what they do is they look at the price and they say, are we going up? Okay, it's a bull market over an extended period of time. Are we going down over an extended period of time? Okay, it's a bear market. But I don't think that's always the best way to measure the current state of the market. I think we can learn a lot from measuring the volatility index and the volatility data of the market, because that gives us a gauge as to where we currently are sitting in the market cycle. What I'm going to do in today's video is compare where we're sitting in the current market cycle in terms of volatility to the previous crashes to look at whether we have a ways to go. And then after I do that, I am going to run you guys through my portfolio, because I'm going to start sharing little tidbits from the portfolio over the next few weeks and run you through some of the projects that I like for that portfolio. So it's going to be a massive show. Make sure you smash the like button if you haven't already to let the people know that we're live. And also, if you're not subscribed, make sure you're subscribed. But I know most of you are loyal ones and are subscribed. So personally, I didn't experience really like the last great recession in 2008. I know a lot of you may have, but I'm a little bit younger, so I wasn't really old enough to realize the full effects. But I must say, this is the worst market sentiment and the worst economic conditions that I have ever experienced, and that's probably about right, because 12 years or 14 years since the Great Recession. So why this is happening is because it's off the back of very aggressive rate hikes. The Fed is hiking rates in order to get inflation down. So by raising interest rates, they essentially can kind of put a bit of a damper on what is happening with the crazy rise in inflation that we've seen recently. Unfortunately, that does sting, because assets start to react accordingly. And we can see this because most major assets are on the move. So if we look at the linear price movement, so just the graphs without measuring the volatility, we could see Bitcoin is down around 60%. Ethereum, being an extension of Bitcoin, being a slightly riskier asset because it kind of comes under the altcoin category, that's down 65%. The euro's tanking. The Great British Pound is tanking. We've seen a lot of drama around the pound at the moment, as many other foreign currencies are devaluing versus the US dollar. So it's very clear that the total return for most assets are down, but the stock market is not quite down as much. We only have the S&P 500 down 25% from its highs, whereas obviously you've got Bitcoin being a slightly riskier version, trading a little bit as a risk on asset like a tech stock, down 65% plus. So there is a good article here, and it says, we all know how this is going to end. The Federal Reserve will stop when the main concern shifts from inflation to unemployment. And that is true. The reason the Fed has the license to hike rates like this is because the unemployment and jobs data isn't that bad. So they know they have a little bit of wiggle room to hike rates into mid next year on the basis of unemployment, GDP data not being too bad. Now, as soon as this gets really bad and the unemployment number skyrockets, and obviously there'll be public outcry, which starts to affect their votes from a political standpoint, then of course we are going to probably see a pivot at that point. But until that happens, they do have a license to keep hiking rates. And the reason they can do that is because while stocks and bonds are down, the markets haven't turned into a complete mess yet. The market, I mean, it's only down 25% from its highs if we look at the stock market. So it's really not down as much as it could be. And we're not at the stage of it being completely broken. But there is a good way to actually quantify whether we are in an orderly stage or a disorderly stage of the market, and that is by looking at the volatility index. So we can look at how volatile the current period is compared to other periods. Now, the example that's shown here is the 60-40 portfolio. So it's a stocks versus bonds portfolio, and it measures the volatility over major historical economic events. So we can see here, if we look at the current period, which is highlighted in red, these dots are the current regime. So this is 2022. This is the current state of the market measuring its volatility. If we look towards the left, this 0% mark means not very volatile market, so a stable market. And towards the right, this 80%, this indicates a very unstable market or a very volatile market. So we can see that we are currently still in the orderly regime of volatility less than 40%, which is realized on a 28-day rolling basis. The disorderly regime, which takes into account the financial crisis from 2008, as well as the COVID crash from 2020, those significant events started to cause a lot of volatility. And that's why we can see that those terrible events for the economy. And if you go back even further to 1970, you'll see that as well sits on the very far right side of this graph, which means we haven't entered a disorderly market phase yet. So if things were to get really bad, you would think that one could predict that the volatility would get a lot worse than it currently is. So it feels like it's a volatile market, but historically it isn't really compared to some of the other major financial crises we've seen. So in the disorderly regime, you find those crazy events that unfolded. So the COVID crash, the 2008 financial crisis. However, at the moment, we've stayed pretty fairly in the orderly regime. So although the portfolio is hurting, it's doing so in an orderly fashion. But let's look through some other markets as well. The USD to Japanese yen, that's still pretty orderly. Tesla, fairly orderly. And we can see as well the COVID crash, the financial crisis on the right. You can see the S&P 500. So where obviously the red dots, that is still in the orderly regime, 60-40 portfolio, NASDAQ, basically every single asset, including Bitcoin and Ethereum, by the way. It is still relatively not volatile compared to previous crashes that we've seen. So bonds and stocks have been not too volatile over the last year. Some currencies like the British pound or the yen are starting to show that volatility, but cryptocurrencies haven't shown it as of yet compared to other asset classes. And they really haven't shown it compared to other crashes in the past as well. So I guess what we can take from all this and take from this volatility index is that we are kind of one step away from how bad things can get. So it's just one indicator that we can use to quantify how bad things could potentially get in the future. And I don't think we will reach that true stage of capitulation and this terrible economic collapse until we do start to see that volatility start to increase. And I guess you could consider us being one step away or one policy mistake away from a meltdown. So although this doesn't guarantee the worst is to come, because we can't say just because previously we had volatile markets that this market will enter the disorderly phase, it is certainly something to keep our eye on as we kind of move more towards that territory. And I think it's just a sign of caution. So big ups to Econometrics for that article. It was very insightful. But if we look on a more if we look on the price basis and not on the volatility basis, we can see that we are currently sitting in terms of the S&P right in the middle between the COVID crash and other insignificant drawdowns. But if we look at other major recessions, the Nixon recession, where the market went down 40%, the dot-com bubble, where the market went down 50%, the Great Recession, where the market went down 60%, you could probably think of this crash as pretty mild. I mean, we aren't really anywhere near those previous events, even though you could argue macroeconomic conditions are trending towards a situation which could inevitably or could end up being comparable to some of those crashes. Now, it hasn't happened yet, hence why the market isn't pricing in some crazy doomsday event like some of these other events were. However, it is still interesting to note that we aren't quite off those levels. And if we look at Bitcoin and Ethereum, which are represented by this little orange dot here and this pink dot here, we know that we are still 40% to the downside away from Ethereum's lows from the last bear market. And we're also similarly away from Bitcoin's lows from the last bear market. So they haven't drawn down as much as other assets either. So I guess what I'd take away from this price data is, if the S&P does end up going down as much as it has in the past, or at least if the S&P continues to draw down as investors go slightly more risk off as things worsen globally, then there is still downside for crypto, because because crypto is so correlated to the stock market, if the S&P had another 20% drawdown, you would see those drawdowns of 40+% in Bitcoin. And obviously Ethereum is even extended. Altcoins are even extended from that. So the only logical assumption to draw from this is that the worst may not be in yet. And when that comes, Bitcoin and Ethereum can continue to draw down. And we can even see Macro Alpha did a post. This red line currently represents where we sit in the history of US equity drawdowns of the S&P 500. We can see this red line is where we are currently sitting. And we can see this is other crashes. So 2020, 2008, the global financial crisis, 2000, the dot-com bubble, the Nixon recession. We can see all of those events plotted against where we currently sit. And we know we aren't quite there yet. We aren't quite there in the scheme of other major global collapses. Now, obviously, this, as I said, it doesn't mean we will get there because the government seems to have this propensity to step in with stimulus these days, and they don't want a crashing economy. They certainly don't want equities going down another 40%. However, long term, this kind of policy of continuously increasing the monetary supply, it's not going to end well. It's only going to result in more inflation, and that they essentially just have to keep stopping and going in terms of tightening and loosening and tightening and loosening, which isn't a sustainable policy long term. And I think the downstream effects of that can be significant. So if they do step in with the money printer again, then that's just going to cause more issues. And maybe it is worth, from a Fed perspective, to let the market cool off a little bit naturally over the next 6 months. And that seems to be through Powell's hawkish language, what they want to actually do. The Bank of England, obviously in the face of a major currency collapse, they've now said that they're going to step in and buy UK bonds in an attempt to avert financial risk. Essentially, what this means they're doing is they're turning on the money printer again. This is a form of quantitative easing, or QE, something we usually only see in obviously periods where they are trying to increase the monetary supply. Although given the fact inflation is so high, implementing a strategy like this is what you would consider counterintuitive, but it just shows how dire the situation is, that they need to buy bonds in an attempt to save the economy, even though they have an extremely high inflation rate of over 10%. Alex Becker did quite a scary tweet on this. I won't read out the whole thing, but he essentially said Bitcoin is at the green steps. They're not a reserve currency, so they skip to the bottom. He kind of plotted out all the major currency historical collapses, so 1930, 1980, 2022. He's putting Britain in that category. He says Britain's screwed. They're rushing to print money to cover the debt call and pay debts in dollars. The US is 5 to 10 years behind. Elites know the pattern. It resolves with massive losses for them because their wealth is mostly from debt and leverage in the reserve currency. They basically took money in banks, loaned it out 1000x while printing more of it to then loan it out. Nothing is there. It's Luna/UST times 1000. They have to keep you in the Ponzi when dollars drops and you go for gold. They basically have given themselves trillions of UST. Like, he's basically comparing the England situation and what the US is doing to what Do Kwon did. And in a way, although I think he's being a little bit rash, in a way I do agree with him. That is essentially what's happening here. And I mean, this is unprecedented money printing, and this is also an unprecedented monetary response. So it is quite scary times to be in the market. And then we also have this volatility calendar over the next 3 months, which has some major events. We have the US CPI, multiple prints coming in, the Fed FOMC, interest rate decisions are plenty throughout the next quarter. So it will be a volatile quarter, guys. There is a lot of major events, and we also have earnings season coming for stocks, and we already know that stocks are starting, or some major companies are starting to decrease production, like Apple decreasing their phone production by 10% because of an expected drop in demand. So if that's anything to go by, then maybe stock earnings won't be so great. So wow, I got all that out of my system. What is the big takeaway here? Well, the takeaway is that there is probably still further downside, and it would be remiss of me to expect a crazy pump over the next few months, given the fact that we have so many headwinds. In fact, the road out of this may be a little longer than we first expected. And that is a scary thing for all investors, but that is also a massive opportunity. And it's times like these where we need to start preparing ourselves for the worst, because the worst is when the best opportunities come. Now, in terms of October specifically, I don't necessarily foresee that being the lows. Of course, I could be wrong there. El Capo's calling for lows in October. Personally, I'm not, just because midterm elections are on November 5th, and October's historically been a pretty good month with a plus 22% historical performance on Bitcoin. So October isn't really when I'm looking for the full damage and the full extent of these rate hikes to be priced in. I think maybe closer towards the end of the year, Q1 next year. That's more my time horizon for something like this. But we really do have to start preparing. So I'm going to help you guys get prepared over the next couple months. And the first way that I'm helping you guys get prepared is by sharing some of my portfolio with you. Now, I said I'd be sharing this portfolio, which is 50 projects, on the show over the next few months, but I'm going to do it very slowly because I want to actually give you logic and I want to deep dive. I don't just want to give you a portfolio of 20 projects and say, this is the portfolio. I want you to understand the logic behind each project, my reasoning behind each thing in this portfolio, and then also give you alternatives, because your investment situation and my investment situation are very different. For example, you'll notice that in this portfolio, there's no Bitcoin and Ethereum because I'm not counting that as part of this portfolio. I may open the door for myself to hold some Bitcoin in kind of like a separate account or a separate portion of my portfolio, but I'm not counting it as part of this portfolio because the goal here is growth for next cycle. I don't believe Bitcoin's the asset to achieve huge growth next cycle. So I'm not putting it in. But if I wanted to use Bitcoin as kind of a gold replacement in my equities, because you guys know I trade stocks as well, then I may consider doing that later down the track, taking some profits into Bitcoin. That's certainly a valid strategy. But for my whenever it happens, next cycle portfolio, these are the projects I'm looking at. And you can see here, the top 3 holdings are BNB, NIA, and Solana. I'm just going to get into the logic behind why I have these 3 in the portfolio. But remember, just before we get into that, we have a pretty awesome $1,000 trading bonus right now. So if you do want to get a $100 bonus in USDT, which can go up to $1,000, all you need to do is deposit $1,000 in your ByBit derivatives account, and then using the airdrop link in the description after you've deposited, you can claim your free trade of up to $1,000. It's an Ethereum trade, so you can long if you think the market's going to perform well. If you think we're going to see further downside, you can short, essentially risk-free, because you're getting a free trading bonus. So if you don't have a Banter Bybit account, I highly recommend signing up so you can get access to these bonuses that we give you on the regular. So cool. So my BNB logic here, and I'm going to go through this quite quickly because I want to be very concise. The reason I have BNB as such a large percentage of my portfolio, coming around at around 10%. By the way, these percentages are subject to change over the next few months, but right now I have it at 10%. The reason I have it here is because of the relative strength it's exhibited. If we look at Masari, BNB is down 60%. Look at all the other coins, guys. Ethereum and Bitcoin are down 71%. Cardano and Dogecoin are down 90%. Solana's down 90%. BNB is down 59%, less than everything during this bear market. And why? Because you're capturing exchange growth upside. We know Binance is the biggest crypto exchange by far. Binance does the most volume out of any exchange. And because of this, you have something underpinning the BNB token. We can see the exchange data here. Binance is killing the competition, although FTX is increasing. The Binance volume is still roughly 10x the next closest exchange, including Coinbase. And the reason why the BNB token is performing so well is because you A, capture the upside of the exchange growth, and B, capture the upside of the change at the same time. So you're essentially taking A, a bet on CZ, and B, a bet that Binance will remain a very relevant exchange, which I do believe it will be. So if BSC does fail, which is the smart chain, I still think BNB can perform well because of the functionality it has in the exchange. So you can obviously stake it, get some better fees. You can eventually they might implement a buyback program. Basically the features are endless. We haven't seen that many features yet, but CZ could easily just change the tokenomics and make this very, 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 very relevant to hold for anyone on the Binance exchange. So I do like BNB. And yeah, that's definitely the biggest holding because I think it's one of the safer bets. Coming in at number 2 is NIA Protocol. The reason I have it in number 2, and it's equal with Solana, is because I wanted a high conviction player around the $3 billion market cap range. So when we look at L1s for next cycle, I could put it in Cardano. I could put it in Polkadot or one of those safer assets. Like you've even got XRP, irrespective of what you think of XRP. But I my portfolio is really aimed for growth here. So it's about capturing upside whilst maintaining a decent risk profile. And I think NIA Protocol fits that very well because 2.8 billion is not an exorbitant market valuation, but it certainly is a market valuation that still has room to grow. So 3 billion can go to 60 billion in the next cycle. If Ethereum hits 300 billion, then 60 versus 300 isn't very unreasonable to expect, considering that NIA Protocol has sharding, which is the major feature that Ethereum is going to get in like 3 years. NIA Protocol has it right now, and NIA Protocol has the backing. Look at this. Look at these backers, guys. $800 million funding initiative program to incentivize new development. We know how important new development is when it comes to blockchains. $350 million raise just earlier this year. So they raised more capital on a multi-billion dollar valuation. They also recently unveiled just a couple weeks ago a $100 million Web3 culture and entertainment kind of gaming entertainment VC fund. So they are very heavily backed, and the development data is showing NIA Protocol, which hasn't been in the top 20 for quite some time, is now starting to get that development, coming in at number 18 out of all blockchains for development activity. So yes, it is a little bit of Cosmos, and yes, it is a way off Ethereum, and I'm not claiming for it to be overtaking Ethereum anytime soon, that's for sure, but it does have a very nice growth pattern that it's exhibiting. So it is showing strong growth off the back of these initiatives. There is a lot of amazing projects launching on NEO that I'm going to be diving into over the coming months. And I just like it, guys. I just like it. I think the tech's good and there's a lot of development happening. And I just like it as a project. And that's why it comes in equal with Solana. And then I couldn't not put Solana in at equal weighting at 7% because I love the Solana ecosystem. I just think it has this very unique niche with the gaming and NFT ecosystem. I mean, if we look at the data here, the Solana NFT sales have been extremely strong, although behind Ethereum. $2 million a day in sales, even in a bear market, is not something to snuff at. And I know this data was closer to 20 million during the peak of Solana. So we know it has that scope to get back there. It really is a very developed community in terms of its gaming and NFTs. And that is the niche that I kind of want to cover in my portfolio. And it's one that I think Solana does quite well. But you also get exposure to DeFi, which is actually quite exciting on Solana. You have projects like Serum, which I'll also be placing a small bet on relative to my Solana position, which is the major AMM liquidity provider for other DEXs in the Solana ecosystem, and it's a DEX itself. And this is also a good project in my opinion. You've got Radium as well, and on Near Protocol, you've got Ref Finance, which is the equivalent. I always put in roughly 10 to 20%, depending on how risky you want to go. I always put in a percentage of my L1 holding into the ecosystem. So if we look at the Excel here, if I put 7% into NEAR, maybe I'll put in 6% to NEAR directly, and then 1% will be allocated to, let's say, Ref Finance and Aurora. And then on and any upcoming projects, because of course there's many good upcoming projects you want to save capital for. So I will save room for these new projects, because guys, just remember, not all projects that are around today will be the winners next cycle. There are going to be new projects that are born in the bear market that end up outperforming some of the existing projects. So we got to keep capital available for these. So that's why I have a lot of space to do so. And then Solana, maybe you allocate to Serum or Ray. This just gives you exposure to some of the ecosystem. And the reason I'm betting on Sol, just to get back to my original point, is just due to the network activity. So if we look at all blockchains and we look at the current usage, the current user growth, and the current transaction data that we have, we can see that Solana is basically the top blockchain. And I want to bet on something tangible here. If you notice a theme from my top 3 holdings, everything is quite tangible in the sense that BNB has exchange-driven growth. So you're kind of hedging, in a sense, having the upside to the exchange growth. Solana has the strongest transaction metrics of any chain. And then Near Protocol has the strongest backing dollar-wise of any chain, or at least close to it. So you've kind of got something tangible backing all these chains. You're not really relying on crazy community speculation and hype. And that's why they are in my top 3 for now. Obviously, this can change, by the way. I almost consider putting Matic in the top 3. Matic is on this list, of course, further down. So don't get all angry if your project's not on the list, because over the next few months, we're going to dig into what is underneath the big black cover here, and we'll get into all of it. But we're going slow and we're easing in, because I don't see the point in rushing and giving you guys rushed advice when I personally want to really dig deep myself in my own spare time. But Solana's been one that I've been bullish on for a while, because of the monthly data. Look, 19.21 active monthly addresses on Solana. All right, that sounds impressive, but let's compare it to Ethereum. 12.67 million. So Solana has more monthly active users than Ethereum. Absolutely insane. And even at its peak, it had 37.2 million active addresses. Ethereum at its peak during the bull run, 20.43 million active addresses. Of course, this is largely because of gas fees. However, it is still very impressive. And I want to bet on tangible metrics. And if you want another tangible metric, Solana's transactions supremely outweigh Ethereum as well. Like, I think even in the bull run, Solana was doing like a 10x Ethereum daily transactions. Of course, a lot of it is NFT driven, but the reason why I am bullish on Solana is because you have those real metrics underpinning the blockchain. So this is my top 3. The reason why I pivoted into the portfolio discussion today is because the data that I showed you that suggests the lows may not be in for crypto, that is bearish data if you look at it at face value. And that's something that is quite scary to look at and visualize. But it's creating a massive opportunity. So now is the time to prepare. Now's the time to get serious. Create your portfolio, create your watch lists, because next year when we do get any major drawdowns, if we do get the lows, maybe even sooner than that, if we get a low in the next 3 months, and you guys aren't prepared for that, and you don't have your watch list prepared, and you don't have capital ready to take advantage, well, then you're making a huge mistake. And that's why I'm so excited at the moment. And that's why this is actually the most important time to be researching and putting the work in, because of the massive opportunities we're going to get for next cycle. Now, this bear market may be extended. It may not be short and snappy. And in fact, once the lows come in, it probably isn't just a fact of hitting the lows and then bouncing straight back up. We probably see a sideways market for quite some time. But this is good, because I don't know about you, but most of us aren't sitting on millions and millions and millions and millions of dollars in a lump sum ready to deploy into the market. Most of you, like me, rely on cash flow. Like, I have businesses which generate monthly cash flow. And that cash flow, because it's earned monthly, can be DCA'd into the market. And I'm sure most of you earn money fortnightly or monthly, and you probably have a percentage you DCA into the market. So it's actually good if we get a sideways market for at least 6 months, because that gives us 6 months of DCAing rather than having to invest very quickly in a lump sum and trying to pick the bottom, which doesn't work. Now, people tell me that the DCA approach is broken, and I agree with you that it's broken if you DCA during bull markets, and if you try and catch the bottom in bear markets. So what I do when I DCA is I pick the worst possible conditions, and that is when I ramp up my percentage DCA amounts. So when the market is looking extremely red, extremely grim, and it's going and it looks extremely bearish, that is the point where I'll ramp up my DCAs. And then when we start pumping, that's when I start taking profits, and that's when I look to scale out. So the reason the DCA strategy fails for most people is because they have a linear DCA system, which means you invest the same amount monthly every single month. Now, this does work with a very long-term time horizon, but it only works for assets you know are going to be around in 10 years. Bitcoin, Ethereum probably are going to be, but some of these altcoins for next cycle, we don't have any verification that they will be. Even though we'd like to think they are, the reality is we don't. So it doesn't really work, in my opinion, the $100 every single day thing or the $100 every single week thing, because you are constantly buying into pumps and then you're not taking advantage of dumps. So I use an adaptive system of much faster scaled in DCAs when the market's down, and then also scaling out via DCA when the market's up. So when I say I'm DCAing, and people give me shit for it, that DCA is kind of just a very broad term for not buying all at once, because everyone has a different version of that. And your version will depend on A, your cash flow, B, your outlook and your time horizon, and C, your risk tolerance as well. So all those factors come into place. That's why I can't give you the best DCA strategy, because you need to weigh up those 3 factors yourself and work out the strategy that works for you. But you guys know how I'm doing things. So I hope you enjoyed this video. We started quite scary, but I think we got a little bit less scary because this downtrend is going to create opportunities here. So thank you everyone for watching the show. And yeah, I will see you in the next one. I'm actually going to go onto Instagram before I forget. If you do want to ask any questions based on the portfolio and you want to discuss it even more, we can head over to Insta. I just went live just then. So link in the description to head over to Instagram if you want to continue the discussion, ask any questions. We'll have a bit of a chat over there. But for everyone else, I will see you in tomorrow's show. Peace out.